So last week, I had, I guess I should probably begin by letting you know I am a prosecutor. I do real estate fraud, and I'm kind of an oddity in the office because I actually like white-collar crime. Most people want to see the guns and the knives and the blood and the guts. And I actually like this white-collar crime stuff. At the same time, I want you to know, as I share this information with you, I probably don't know a whole lot more than some of you that have taken money in banking. When I was in college, I went to Walla College and I finished here in business. I really, really liked economics, but I was a really bad math person. So I just knew that wasn't my future. Nevertheless, I really liked money in banking. And so, of course, when I see something like this, which you'll hear every day, you'll know that it's a real interest of mine. At the same time, I'm not an economist. And I hope that most of what I'm sharing with you here today is accurate. If it's not, you can probably look on the internet and see what the truth is. But that's where I looked. And this is the way I gathered the information. Just to give you just a quick background, it may appear to you that the background that I'm about to share with you is kind of boring and like, what's the relevance of it? And I think it's extremely relevant, and you'll see that at the end of my talk as I begin to talk about the cases and how they all really culminate with what the criminal element has figured out that you didn't figure out, and your parents probably didn't figure out, and I didn't figure out when it was taking place, and had we known, we might have invested differently. Nevertheless, Fannie Mae and Freddie Mac is a bank. It's called the GSE, which is a government-sponsored entity. I don't know if have you guys seen It's a Wonderful Life? Show of hands? Okay, not a lot of people. But anyways, if you see The Wonderful Life, which is a Christmas movie, very old, black and white. It's got, it's a story about these bankers that really take over. They take over people that typical people's homes, and that's kind of what the story is about. But it's a local banker, and back in the day, that's if you wanted to buy a home, you had to go to your local bank, and those local bankers are people you went to school with. It might have been that that person sitting next to you in high school that you remember that was kind of lazy, didn't do anything. You kind of have an opinion about what he's like, and he comes to your office. You're a banker now, and he says, "I want to borrow some money," and you're thinking, "Not you, loser. I'm not loaning you money." And that's the way it used to be. They would look at, and they kind of knew who you were. So there was some validity in the loans when you made a loan in those days. The Fannie Mae and Freddie Mac, however, what ended up happening was the local entities were unable to really acquire the amount of capital that was necessary for an economy to really go forward like they wanted. And so they decided back in the 1930s, during the Depression, that we needed to figure out how to infuse capital in an economy when the economy is in doldrums. And so they created Fannie Mae at that time. And it was a government-sponsored entity. What they did is they put the government infused money into the bank, and the bank then loaned money to people. Now, it was successful. They later created what's called Freddie Mac, and they used Ginnie Mae, it's called Ginnie Mae, to securitize the funds that they had. I know some of this might be really, really basic to you guys, and I apologize for those of you whom it is. I did speak to some last week that said I lost you last week when I started talking about the securitization. So anyway, if you look at essentially what's happening is the bank has a total assets of $100 million. FDIC, after the run on banks that took place in the Depression, they started having the FDIC, which is an insurance, and it required you to have a certain amount in reserve. And so I just put that in there. It's $10 million, which means the total amount of loanable assets that a bank has is $90 million. That $90 million, if they're loaning for $300,000 homes, which we have today, which is kind of the average medium amount, you can buy 300 homes. Well, what ends up happening with those 300 homes is these 300 homes or mortgage loans are bundled together to form an interest-bearing security bond. It's a bunch of bonds, actually. And they're bought and sold in the stock market. When you buy and sell those stock market, you've created another $90 million. Cool. And then they go around, they do it again, and a few months later, they do it all over again. So it just starts building. You can see that that initial $100 million can really begin to build pretty quickly. In the 1970s, there was a question regarding home ownership in our country. Home ownership in World War II, after World War II, was about 45%. In the 1970s, it had grown to be 65% of home ownership. But the problem was that the inner cities and lower income, primarily minorities, were not getting loans and were not getting homes. So those who did own homes were not low income, they were not inner city, and they were not minorities. And they wanted to fix that. So they passed some legislation in the 1975, 1978, stating that that was going to be our goal for Freddie Mae and Freddie Mac to loan money to these areas, to this sector. And they made initially, as I said last week, this is just bringing you guys up to speed somewhat, but 30%, they said that 30% of the homes, or the loans, needed to come from, or needed to be used to fund inner city and low income minorities. But they got some resistance. They got pushback, and they said, okay, we're not going to require it, but we're going to ask you to please try to do it. Okay? It didn't work. In the early 90s, they found that the home ownership had leveled off. It was actually still at about 65%. It hadn't really gotten any better from 1975, 78, when they said they were going to try to do better. In 1992, the Boston Federal Reserve made a claim that there was a great disparity in the loans that were being provided for minorities, and they felt that there was this great disparity. Again, now, the Department of Justice, at the same time, said what we're going to do is we're going to file a lawsuit against you, the banker, if we, in reviewing your bank, and we find that there is this disparity, you're going to lose. And you're going to lose government support, and without going too much into that, that's big for a bank, to not have government support, because they really are intermingled. And I spoke last week about the problem with that, with the Department of Justice saying that they're going to file a lawsuit against them. Lawsuits, you'll learn in business, to file a lawsuit, you don't have to be right. You just have to have enough money to support your claim. I did not know, I actually ended up working for a business litigation firm after I worked for Ernst & Young, and I came to find out after my 1 year of employment there with them, that the lawsuit I was involved with, all that we were doing was creating false claims so they wouldn't have to make the payment to the acquirer. I'm sorry, the person they acquired. So they acquired a business, there was, they said there was bad inventory, and there was. It wasn't like a facetious claim. We did find some things, but nevertheless, I'd come to find out later that they really didn't care whether we won or lost. The company just wanted us to hold off so that they could hold off on paying the $100 million that they owed. And they were willing to pay us the $1 or $2 million that they paid us to do that year. So the problem is that the Department of Justice files these lawsuits. The point is that the bank realizes that they're going to have to go back and prove every one of those loans why that loan was rejected, and prove that it wasn't discriminatory. And so at that point, they're going to say, you know, it's too costly. Let's just go ahead and do it. It's easier and better for us, more cost-effective to go ahead and do that. 1992, there's the Federal Housing Enterprise Financial Safety and Soundness Act. That's a rather misnomer, actually, because it had nothing to do with safety and soundness. Give me a moment. What this act did is it required Fannie Mae and Freddie Mac to provide the loans to the low income, even though they knew that it was not financially sound for them to do that. And so Fannie Mae and Freddie Mac were supposed to subsidize that loss. that they knew was bound to happen. In 1994, so if you follow this through, you see 19, I want you to see a global picture of this, and I know if we go to this too much detail here, you'll kind of miss the whole big picture, which is what I'm trying to get you to see. 1975, they have this intent to try to help low-income inner cities. 1992, they see it didn't happen. 1992, they say, okay, we're going to try to infuse this some more. 1994, this is something else that's happened. The HUD, the Housing and Urban Development Department directs that at least 30% of loans be given to below median income households. But this is more of a directive than it was the first time. The first time it was a suggestion, and this time it was a directive. It was poor credit risks. They knew that this 30%, if you can imagine 30% of the loans that your company was giving was a poor credit risk. That's a lot. That can make you go under. These losses were expected, but the large banks were expected to cover that risk. Now, if you're a banker, you're going to be thinking right now, in 1994, how are we going to do this? We got to be creative. In 2000, HUD directs that the portion of the required GSE financing come from 30% to 42%. So now, six years later, now they're saying, now we want you to go from 30% to 42%. The banks are doing it. The losses resulted in reduced capital. Why? Because people weren't paying their loans. And they started withholding credit in 2000. Nevertheless, I don't know if you probably don't remember this, but that's when I bought my home, 1999. And I do remember the market, the housing market was down. And people weren't buying homes. They weren't really willing to loan the money. Nevertheless, policymakers wanted the banks to continue to lend, but the important thing to note here, and that's why I bolded this, is that Congress did not, at the same time, earmark funds to pay for the losses that they were guaranteeing they would cover with Fannie Mae and Freddie Mac and the commercial banks. So, how many of you ever heard of this mortgage-related credit default swaps? One, two, a lot. Okay, so mortgage-related credit default swaps these are derivatives, and they are intended to eliminate the risk of bad loans. And they also free up the capital because now you don't have to hold money in reserve for a loss. And what they did is essentially a derivative here. It's really very simple. It's an insurance policy. And they sell this insurance policy to, or they buy this insurance policy from another banker or an insurance company or another financial institution that's willing to cover your risks. The problem with the derivatives, there's an interesting documentary called Behind the Meltdown. If you want to see this, it's kind of interesting. I'm not sure I completely agree with it, but I think it's a good thing to talk about how these derivatives actually knew about them back in the 1990s and said, that's okay, we're not going to regulate them. Here's the problems with these derivatives. They're private contracts, so these were between the bankers or between the lenders and the insurance companies. Who else knew about them? Nobody. Wouldn't you want to know if your company that you had invested in, that that they had 30% of their assets that were taken in a risk in another company's assets, and another company's well-being? Wouldn't you want to know if you're with AIG that Lehman Brothers, they had billions of dollars with Lehman Brothers? When Lehman Brothers collapsed, to know that that actually could cause the collapse of AIG, the largest insurance company in the world? Wouldn't you want to know that? You'd want to know that, but you didn't know that because it was a private contract. It wasn't traded on the exchange, and it wasn't regulated. If it was regulated, you have record-keeping requirements, and there's no way to know what money you owe without that regulation. That's the reason why you would want it to be regulated, almost like it was a stock. So these things, So if you look at this bottom portion, it's rather chilling, but it started, I could not quite figure out when it was started from different articles. It sounded like some of them are mortgage-backed, but they're not all mortgage-backed. Some of them aren't related to mortgages at all, but they are related to loans. And back in the mid to late 90s, it ballooned into a $62 trillion market. $62 trillion. 4 times the value of the stock value traded in our country. And so you can imagine when the meltdown started to happen and they started pouring through it. When Lehman Brothers collapsed, when it was collapsing and they went to get a bailout like Bear Stearns had gotten, and they started pouring, the Federal Reserve started pouring through their documents and they came across these derivatives that they've seen in the contracts and thought, oh my goodness. And they began to realize that's why they had to bail people out. When Lehman Brothers was allowed to collapse, it wasn't until they collapsed that they realized that, oh my goodness, AIG is going down because they can't cover all of the losses of Lehman Brothers. Now, if the entire system collapsed, that's what would have happened. $62 trillion would have had to have been paid up. That's why a collapse could not have occurred. The GSEs represents, I think I said earlier, a government-sponsored entity, and that's Fannie Mae and Freddie Mac. That's it. But the GSEs and commercial banks began to compete for the same customers back in the 90s, specifically and into the 2000s. In 1989, deregulation of the banking industry permitted interstate branch offices to occur. Now, I was working, and that was 1989, I began to work for Ernst & Young back in 1996, and I was sitting next to two of what's considered to be the gurus of the banking industry for Ernst & Young. They knew all the bankers, and they were always in there talking, and I talked to them a couple of times, and one time they told me that the banks, all the banks that we're seeing now, that was back in 1996, 1995, they won't exist. You're going to only see a handful of banks in the next few years because one bank was acquiring another bank and another and another. And the way that they were doing this is they were going interstate. Before that time, we didn't used to have interstate banking. B of A could only do banking. Before 1989, B of A could only be a bank in California. Citibank was only in New York. Chase, only in New York. All of those banks were local banks. And the deregulation allowed all of the cross-border or border cross that we see here. But it becomes significant because when the deregulation occurred, in order to go cross borders into other states, you had to agree to provide for this lending to low income. So the banks were caught in a pickle. They either had to do that or they were going to be able to go interstate. And if they go interstate, they were going to be able to compete. Now, the second bullet point, I think it's the second bullet point that I have, the effect of the FDIC extended to GSEs. When you have an FDIC, which is a guarantee by the government that they want you to keep a certain rate, a certain amount of reserve. But when you go past that reserve, the government will help the bank with that. So that you're supposed to, they'll cover you up to $100,000. So if you have more than $100,000 in your bank, you need to go to another bank because they're only going to cover up to $100,000. And so when you split your assets that way, if you don't, then and the banks lose more money, the FDIC is going to come in to help cover the costs, the losses. The GSEs, Fannie Mae and Freddie Mac didn't have this, the FDIC coverage. But they were starting to compete with each other, and they didn't think it was fair that commercial bank got the FDIC covering and the Fannie Mae and Freddie Mac didn't. So what they started doing is both explicit and implicitly telling Fannie Mae and Freddie Mac, you continue to make the loans to minorities and to low income, or you continue to do that and we'll cover you, just like you do the FDIC. So they began to level the playing fields, although it wasn't quite level, but as you read through it, you'll see a lot of regulations taking place to try to make it level. But what ended up happening was conforming loan applicants maxed out. There was only so many good credit risks that you can take. After that, what do? Well, Fannie Mae was going after them. You'll hear them as FHA loans or conforming loans is what they're called. They conform, they're good loans. No credit risk is there always, but it's a good credit risk. Because they had maxed out all of those people, they now had to try to go after the non-conforming subprime market, people that weren't getting loans before. So you can see it starting to trickle down. I don't know if you got to see the movie, Margin Call. There's a couple of characters that were in there. I thought it was funny when I first saw this. I thought, why are they, there's one point where he says, oh, so you're really a rocket scientist, because they were really from MIT, and they were mathematicians. And when I saw the movie, I thought, well, why did they do that? Why would Hollywood do that? It just seems like ridiculous. I mean, no one's going to hire a mathematician to work at a bank like this. Well, that's exactly what they did. But what these guys were trained to do was to do the math on the derivatives that they were now starting to do. In 2004, the housing market peaked. Banks reduced their lending standards. They reduced them or eliminated and I remember when this was happening, they caused a 25% increase in the housing prices when they reduced the lending standards. So when they actually went from, I think, 10%, you had a 10% on conforming loans, you had 10% of down payment that you had to give, 10% of your house value. In 05 and 06, it went to 0. And it continued to do different things like this. Then there was what's called a PMI insurance that you used to have to get. And that was just, if you couldn't come up with a 10% or the 20%, then you had to buy insurance to cover that 10%. But the PMI insurance industry, these companies, began to recognize that based on what had happened in the 90s, they could not sustain these losses. They stopped issuing PMI insurances. So now what they had to do was the lending industry had to go to what was called second trust deeds. You have a first trust deed. If your value of your home is $200,000, your first trust deed might be for $108,000, $150,000. Your second is going to be another $50,000. And so the first trust deed is actually the most secure. This is kind of chilling. 2005, the CEO for Freddie Mac, Richard Siron, fired David and Drew Konis, Freddie's longtime chief risk officer. That would be like your insurance person trying to tell you what the risks on your company. He fired him because Andrew Konis was concerned about relaxing underwriting standards to meet mission goals. Now, what's the mission goal? The mission goal for Fannie Mae and Freddie Mac and the rest of them that's been imposed on the banks and Wall Street was 30% and up to 42% of your loans have to be to low income. Its replacement continued to make the case to increase capital to cover for the increased risks, but was ignored. All of this is documented. I didn't make this stuff up. I have a report I'll give you at the end, if you want it. Now, in the margin call, we have this picture at the very beginning of the movie. This particular person is risk management. He's being fired. Among those cut is Eric Dale from the company that's going down. He's the head of risk management. As he's ushered by a security guard, he slips a key drive to his erstwhile minion, Peter Sullivan. Now, I was working on something, but they wouldn't let me finish it, he hisses. Be careful. Now, if you go back and read about margin call, there's one article I came across that said, well, you know, they had to really dumb this down, this movie, because you watch the movie, you just see a lot of emotional antics, like, what are they getting so excited about? You know they're excited about something, but you can't figure it out. They never discuss it. And this is what they're talking about. This is what was going on. Richard Siron, a former public servant with no business experience, earned a whopping $23.5 million in 2005 to 2006. The guy who fired his risk management person. And an additional $18.3 million in 2007. And then they call it Green on Wall Street. Now it's 2000. Uh-oh. I'll keep talking. The picture you just saw just briefly was of Michael Devon. I talked about him last week. And for those of you who are here, Michael Devon got out of the federal penitentiary in 2004. And I think it's more than just a coincidence that he goes right into real estate fraud coming out. He was there for 14 years. How would he have any idea what was going on? In 2005, he did some stuff that was about $1.2 million worth of real estate fraud in LA County. Then he came to our county in the beginning of 2006. The end of 2005, the beginning of 2006. And so he, as I said last week, in the court, he actually was talking about these greedy Wall Street people that were giving out loans for nothing. He was one of those low-income people we're talking about. And you know what? When I heard him make those statements, I started researching this stuff, and this is actually part of what I argued when I was able to get the stiff sentence that I got him. He said, you know what? This is the kind of person that these programs were designed to try to help. And he took advantage of it. And the people that he was trying, that other people that were of good character, and it's not like he was dumb. He wasn't dumb. He could have done it. He could have helped himself, but he chose, rather, to choose a dishonest route. The next one that I had to show you was a lady by the name of Katrina Saxon. Katrina Saxon had been in custody between 1999 to I think 2002, 3 years. She was in for identity theft. She got out, and I don't know how she figured that out.
Someone more computer savvy than I am.
Okay. All right, Katrina Saxon, very smart. She didn't have any real estate background, was not a real estate agent. Again, all she was good at was identity theft. She used some of her family initially, and then she got connected. And all these people, Michael Devon, this lady, other people that we contacted, are always telling us, I'm just a small fish in a big pond. I'm really a small potato compared to what people are doing out there. And it was unbelievable the amount of real estate fraud that we were seeing. But this lady we filed charges her for one count or one loan, fraudulent loan, and inside her car we found her a locker that she had rented. We went to the locker and we found a ton of loans. Too many to really look at, so we just pulled out. I told them just get 10 out of Riverside County. They got 10 out of Riverside County. These are really enormous things to actually prosecute. And what she would do is she would use someone's stolen identity. She'd go ahead and everything on the loan was fraudulent. Your name might be on there. After that, it wasn't your Social Security. It was somebody else's Social Security, someone else's driver's license number, someone else's address. I mean, it was completely fraudulent. And to this day, I still don't understand how the industry could not see it, other than to simply say they were processing loans like crazy. Just didn't have time to really go through it. Anyway, she'd get these loans, and she would tell them, I'm going to buy this home, and it's worth $150,000, but I want an additional $50,000 because I'm going to put a pool in there. So she would get a second on them, and this is what they were doing in 05 and 06. They were getting a second on these homes, and she'd say, and wire the money to this construction company that's going to put in my pool. It's called DRE Home Construction. I thought DRE was kind of an interesting name because that's an acronym for Department of Real Estate. So anyway, that DRE Home Construction was her business. It was her bank account. So she'd have that $50,000 just wired right to the account, and she'd spend it. Now, the banks weren't cooperating with us because when we would tell the bank this was an identity theft, the loan originator didn't want to hear that because that would be fraud, and that would mean that they would have to pay the money. That if you had a $150,000 or a $200,000 loan outstanding and it was determined that it was fraud, of course, we learned last week that loan originator originates the loan, it goes to the next along the line until it gets in this pool of assets that is then securitized, and then it's sold in the market. It's put in a fund now, and once that fund finds out that that loan that's in the fund is fraudulent from its inception, it goes right down the line all the way back to the loan originator, and the loan originator is going to have to pay. So they were not cooperating with us when we would ask them to cooperate with respect to giving us the information. But I want you to think about this is just a tip of the iceberg is what we were really seeing. She, again, wasn't a big player in terms of what we were seeing. Two that are yet to be litigated. One is currently in a preliminary hearing, and they've been doing it for a week now, almost a week, and they'll probably finish the week with them as well. That's Stonewood Consulting. If you want, you can read about it in the internet. If you put in Stonewood Consulting, Press Enterprise, there'll be a ton of articles about this. But essentially what they were doing is the guy, it was a group of about 4 or 5 people. The main player would have these seminars, and they would target churches and church groups, and they would tell them, you know, here's a full fail-safe proof way of making money, and you can, in 3 to 5 years, if you follow our plan, you can retire and be a full-time pastor, which is what these people want to be. But you got to do exactly what we tell you to do. We will buy homes in your name, and we will pay for the mortgage. We know how to make money. You don't have to do anything but to sign on the dotted line. So they did. Let's get all of a sudden, these people would each own 5 homes. They did this within about a 3-year period. To just show you the extent of what they had done, they had taken, I think I may have mentioned this to you last week, but they had gotten loans the extent of $500 million just out of Murrieta and Temecula. 400 homes fraudulently purchased with no real person to house them. And you wonder why we have a glut in our market. This was going on not just here in Riverside, it was going on throughout the whole country. The other one that you see to the right, So-Called Financial, that was one guy, one operation. He did 130 fraudulently purchased homes, the same thing. Funny thing is, he did it on one guy. What he would do is he would buy 5 homes within the 30-day period, so one bank did not know what the other bank was doing. He put all 5 loans in immediately, he'd buy 5 houses, and then he would take out, just like Katrina Saxon did, he'd take a cash out and he'd take all the money. Within 2 years, he made anywhere from $5 to $6 million just on commissions alone. And he can't find money. We can't find money. One of the homes that he had purchased, he was living in. And it was in the name of one of these people that he had taken the identity from. And this guy comes to his house one time to a party because he wants to show how wealthy he is. And it's just this amazing house that he lives in. And he's just impressed. And he's going, I want to be in with you. Can you show me how you're doing this? You're just amazing. So the party ends, he goes away. A couple of months later, he gets a notice in the mail that he's defaulted on his loan. He looks at the document, looks at the address, says, this looks familiar. He goes and he drives by it, and guess what? It's the house he'd been at that party. It was his house. It was in his name. So he was pretty angry, of course, but that's what they were doing, 130 homes. So just between between SoCal and Stonewood, those two alone were over 500 homes without a resident to house them. And it's caused other problems, which I don't have time to cover here today, but it would be squatting, which is another issue that's actually come up for us. These people would not pay on these loans. Stonewood did it first, just to keep it happening, but then they would stop. They learned you don't have to make payments. It takes a month to get somebody out of the house. A month. It takes a year to get them out of the residence. So they wouldn't pay for a year, and just before it was about to foreclose, guess what? They'd find another borrower, another lender to buy that house, and they'd do it again. They would get a fraudulent appraiser, an appraiser to go out and fraudulently appraise that house and jack up the price. I had one lady, this is probably the best way to describe it, I had one lady who owned a home, purchased her home for $200,000 back in I think it's like 2002. Between 2002 and 2007, that 5-year period, she had flipped her home 4 different times under different AKAs to herself. Used different lenders, and from $200,000 to $750,000, 5 years later. So she had taken the cash out value on each one of those homes. And that's what really SoCal and Stonewood Consulting, they would use their own appraised homes. So you'd have one home that they had purchased for maybe $200,000. The next year, even sometimes 6 months later, they get an appraiser that would actually give the price for $300,000. 6 months later, then they use that home to value another home that they had purchased to make that home now $350,000 because they're going to add a swimming pool to it. So now the comps began to jump all like that, all the way that's happening. Now I'm telling you, I haven't scoured everything, but I haven't seen anything about this in terms of why the credit risk that we were seeing take place. If this is what's happening here in Riverside County, I know it was happening everywhere else. So when you're seeing a 30%, I talked to you about last week that in this pool of loans, they found that 30% of the loans that they looked at were fraudulent in a pool of mortgage loans. And it looks like, wow, that's ridiculous, but and they tried to blame Wall Street for that. They reduced the lending standards, and in the Saxon case, I had some people I brought over from the East Coast that would talk about did you guys ever hear about stated income loans, what they call liar loans? No? Well, okay. In the 2000s, they turned these into stated income loans. And when I went to the bank actually once, to Wells Fargo, and asked them, I told them I needed to borrow some money. I was going to get some equity out of my home. And I started signing the loan. I started looking at the loan, and I wanted to read it. And he said, I think I looked at it, and it said that I made so much money. I said, I didn't make this much money. why are you saying this is stated income? I'm giving you my W-2. He says, oh no, this is stated income. I said, no, it's not stated income. I don't want this to be stated income. I want this to be based on my W-2. I don't want this. So then he wouldn't let me. I said, I want to take the loan and I want to read it. He said, no, you can't. I said, why not? I'm signing it. He said, well, you have 3 days to read it afterwards. I said, no, I'm not doing that. Well, he refused to do it, and I finally asked to talk to his manager, and his manager had told the manager, this is ridiculous. I'm not signing this. I want to get the loan here, but I'm not signing it if you don't let me read it. Already I've seen that he's put in here stated income. I don't know what else he may have put in here. I don't like that. I want to look at it. So she allowed me to take it. And of course I was in real estate fraud at that time, so I really kind of wanted to see what was going on with these loans. But that was probably one of the single contributing factors. It wasn't just that they were getting loans on homes that they weren't for a resident, but the fact that they would use these to increase the value and increase the value. And then of course real legitimate people would go and they'd say, my goodness, that home, my own home, I bought it in 1999 for $200,000. In 2006, that home was sold for $650,000. It was a home just like mine across the street and sold for $650,000. And that was because of this jumping that was taking place, where they would keep on increasing the value of the homes. So on 2 scores, number 1, it would buy a home that didn't have a residence for, and number 2, they were increasing the price based on a home that didn't have a residence. Okay, so what was the impact on the local market? It devastated entire neighborhoods. I'm sure your parents are all seeing that. I know we're seeing it. What it's done to our equity value in our homes, what that we thought. The impact on Wall Street, Bear Stearns bailed out. After Bear Stearns was bailed out, Bear Stearns, what ended up happening is these toxic loans that they had, they started coming to roost. And Bear Stearns didn't have them. And they were starting to say, we don't have the money to cover these losses. And that's when they went and they told them about the derivatives that they had. Lehman Brothers, of course, was not saved, and we don't know, well, I'm not sure we'll ever know all the reasons why, but they think they should have saved them because after they went down, that's when AIG went down. Because AIG couldn't cover Lehman Brothers. And the impact on the country, well, you'll know that. So the impact, as this depicts here, the subprime mortgage meltdown could have led to, and may actually lead to, the destruction of the U.S. financial system. Powerful system that we have. And I think it will depend on the character of the American people as to whether or not we really get out of it. And that's you guys. So this is again another trying to make fun of Paulson here. He was trying to do the best he could with what was there. Now Paulson is actually a very conservative, strict market capitalist. He did not want to do what he did. And I think there in the bottom left corner it says he's going to take out the safeguards. That's what fell out is the safeguards. Like he's doing everything except for the safeguards. But really, the story is the safeguards is the bad loans that we were giving out. You wouldn't need those derivatives that they made. It wouldn't even be a problem if everybody paid their loans, right? If everybody paid their loans, who cares about the derivatives? So they want to regulate the derivatives, but not regulate the loans and increase the loan amounts. Now you do. I mean, now it's actually I think it's still pretty easy to get loans. I'm amazed at being able. You can get in with 3% down. Not the 10 and the 20% that I saw, 15, 20 years ago. You'll find some articles in there about the margin call that will say that it was written, actually I think it was written by or produced by the son of an investment banker. So he actually this is a pretty good depiction of how it actually came down. Now he claims that it wasn't Lehman Brothers, but I think he's just covering himself. I do think that as I look at it, it looks to me like it was more Lehman Brothers. And one article I came across talked about They used the name John Toole, and Lehman Brothers' name was Dick Fool. So going back now, I mean, you look back at some of the stuff that they were producing, how Wall Street got drunk. You have George Bush saying, go ahead and drink up. What can happen? It's all based on tax cuts for the wealthy, capital gain tax cuts, and old deregulation. I mean, it's a farce. You know, when you really ask, it's really what really happened, and this is what the dumbing down of America has brought us to. This is where I got my stuff. I thought Margin Call was a good movie, but Inside the Meltdown, there's also Behind the Meltdown that I thought was interesting. The article that I mostly referenced, I'm mostly basing this on, is the subprime lending debacle, competitive private markets are the solution, not the problem. It's written by, what's co-authored by the chief economist for Freddie Mac. And you can tell when you read the article, he's a little bit upset about the fact that that they have they've skirted the issue regarding trying to impose on Wall Street this ridiculous notion that you can give credit risks to these people that aren't good credit risks. Okay, so are there any questions?